Good day and welcome to Q2FY26 earning conference call for Pennar Industries Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinion, and expectations of the company as on the date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participants' lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Vikram Suryavanshi from Phillip Capitals. Thank you, and over to you, sir.
Thank you, Hina. Good morning and a very warm welcome to everyone. Thank you for being on a call of Pennar Industries Limited. We are happy to have the management of Pennar Industries here today for question and answer session with the investment community. The management is represented by Mr. Aditya Rao, Vice Chairman and Managing Director, Mr. Srikanth Bakkar, Chief Financial Officer, Mr. Manoj, Vice President, Corporate Planning, and K.M. Sunil, Vice President, Investor and Media Relations. Before we start with the question and answer session, we'll have opening comments from the management. Now I hand over call to Mr. Aditya for opening comments. Over to you, sir.
Thank you. Good morning and thank you for joining us for Pennar Industries Q2FY26 investor conference call. This is for the quarter ended September 30th, 2026. We are delighted to have this opportunity to share our recent performance and also provide an update on the strategic direction driving our continued growth. As an overview of our agenda, we'll begin with an overview of our Q2 results. We'll highlight key metrics including revenue, PAT, working capital, and our primary growth engines. Following this, our CFO, Mr. Srikanth Bakkar, will provide a detailed financial review. We'll then move into a Q&A session to engage with you and all of your questions. So, performance snapshot for the second quarter, we're pleased to report we had strong growth this quarter. Revenue rose by 22.04% to 919.6 crores, and our PAT grew by 20.13% to 32.28. This reflects our continued momentum across many of our growth vectors, and we're quite happy with what we've generated this quarter. For the key revenue growth drivers, in the PEB division, despite our earlier labor supply constraint, which briefly impacted our margin delivery in this quarter, and something I alluded to on our last conference call, the division delivered solid double-digit revenue growth. With these issues now fully addressed, we are well positioned for a very strong Q3, backed by improved capacity utilization. Ascent, our US subsidiary, has delivered strong double-digit growth in both revenue and profitability. The order backlog also has expanded to $51 million, setting a stage for sustained double-digit growth in revenue and PBT through the remainder of the fiscal year. The acquisition of Telco also puts us in a very good spot for sustained revenue growth in this business, and we expect to see this filtering in the next few months. For our body and white division, we secured significant new orders from Hyundai, Volt, Ashok Leyland, and Stellantis. Capacity expansions are coming online in the coming quarters. Expect this business to robustly contribute to our revenue and an upgraded growth outlook. Engineering services, our structural engineering business continued to perform very strongly. BIM growth, building information modeling, was a little more modest, but we have strengthened our sales and business development teams in the US to support further expansion. Again, we expect healthy double-digit growth in revenue and PBT for this revenue stream. Hydraulics, the order backlog has increased as of October 2025, despite global headwinds as US sanctions, which impact not a lot of revenue, about 2% of our revenue. However, we are proactively expanding our presence in domestic and European markets, especially in Germany. And this segment, while modest in revenue contribution, remains on a stable path, and we have identified this as a key revenue growth vector. Minimal impact for the next few quarters, but over the medium term, they should add a lot to our revenue and profitability. Boilers and process equipment saw a significant rise in order backlog. We are now at 126 crores. With strong execution plans in place, we are very certain of robust revenue growth in Q3 and Q4 also. That makes this a major growth lever for the rest of the year for us. So for the next 2 quarters, this will be a key driver. Profitability and margins, our Q2 PAT margins stood at 3.56%, slightly muted as the revenue mix continues to shift towards higher margin businesses. We expect this positive trajectory to get better. Our capital efficiency is at 21.7%, and return on equity is at 12.2%. Again, confident of advancing these returns over the next few quarters. Working capital days at 76 days. Timing-related impacts primarily because of some of the issues that we had mentioned. Lower than expected revenue in certain divisions as well. Stronger Q3 projections, especially in PEB and other key segments, as we have a full quarter of the issues that prevented full execution from impacting us, should result in notable improvement in capital efficiency. This concludes my performance overview for quarter 2. I will now hand over to our CFO, Mr. Shrikant, who will walk you through the detailed financials. Thanks again for your continued interest and support.
Thanks, Akshay. Welcome to shareholders and investors for the second quarter FY26 earnings call. Total revenue is 906.56 from 747.61, up by 158.94 crore, which is 21.26%. EBITDA has increased from 81.18 crore to 94.43 crores. PBT has increased from 36.05 to 40.94 crores. PAT has increased from 26.87 crores to 32.28 crores. Explaining you the details of it, revenue from our customer design building solutions has increased by 31.9% from 353.13 crore to 456.72 crores. The increase is predominantly on account of our capacity additions at Raebareli unit, which has become functional and also started yielding growth. And also in the US, there is an increase in the building capacity that we had. Because of the combination of the India revenue and as well as the US revenue has grown, the overall PEP sector, which is a custom design building solutions, has grown by 31.9%. Revenue from our diversified engineering continued at growth with a modest growth of 468.26 crores and the overall 12.47%. PEB India order book as well as the PEB US order book are healthy. The other income includes predominantly on account of exchange fluctuations, income from mutual funds, road tap incentives and collections of old receivables which we have returned back in the past. Employee benefits has increased by 14.93 crores in standalone and by and in standalone by 1.8 crores and predominantly on account of subsidies by 13.02 crores. Overall, our finance cost has increased by 6.42 crores, in standalone 7.23 crores and in subsidiaries it is reduced by 0.8 crores. The increase on account of additional revenue and the increase in the capex that we had during the current year. The overall finance cost as a percentage of revenue is at 3.76% as against our plan of 4%. We have guided to 4%, and we are within the range bound. If you get into details, the working capital has slightly increased, and we are hard at work to get this back on track. So with the efforts that we will additionally be putting in, we will see the working capital improved. We have also had increased slightly on account of telco acquisition that we had carried out during the current year, and due to which the increase in the long-term borrowings. When I explain the balance sheet, I'll explain you with more details. In terms of depreciation and amortization, the overall increase is 1.94 crores at a consolidated level. Standalone, it is at 1.81 crores and subsidiary 0.13 crores. The other expenses are predominantly increased at consolidated level by 27.38 crores, in standalone by 13.74 crores and in subsidiaries by 14.13 crores. In standalone, the increase is because of the certain things that we have alluded in the last quarter on account of the higher wage settlements that we had and the higher contractor expenses that we had. That is one of also our reason for expansion for the gap in the margin. With the combination, now that the labor force is deployed and with our increase in revenue, we are confident that we will be able to jump back in terms of our profitability and margins in the coming quarters. Tax is lower due to the credit that we have received on closing some of the assessments in the earlier years. We continue to guide to consider the consolidated rate of 25 to 26%. Overall, revenue has increased in majority of our business, which is PEP India as well as the PEP US and our geographies in India and US. Due to the increased revenue, there is a corresponding increase in PBT and the PBT margins for the quarter. As it's a balance sheet quarter, I just roughly touch upon certain balance sheet points during the quarter. Changes in assets are on account of increase in BP by 102.54 crores and increase in CWIP by 72 crores, inventories by 55 crores and debtors by 107 crores. Overall, there has been an increase in terms of the long-term assets as well as the working capital assets that we have. And there is a decrease slightly in terms of cash and cash equivalents and other remaining assets. Drilling you down on each of those numbers, PP increase has predominantly come in our subsidiaries, which is 118.04. That is predominantly on account of telco acquisition, which we had. Now we have the telco results, which have been consolidated in our present results, and the comparative numbers between the last year and this year looks different on account of this acquisition. The increase in majority comes in buildings by 48.69 crores and plant and machinery by 71.82 crores, which is on account of acquisition. CWIP continues to grow with our expansion that we are doing at Sadashipet, Chennai and Tarapur. Inventory has increased by 46.22 crores. In standalone, this has increased on back of order backlog increase and on account of increase in revenue that we had during the current year. Debtors has increased also on account of the growth that we had in the last quarter on account of increase in revenues. Overall number of days wise, we are higher by 2 days than usual. We are hard at work to get this some of this old stuff collected at the earliest. Investment increase is on account of increase in the JV investments that we have carried out for the plan that we have alluded earlier. Cash and cash equivalents, there is no change in coming to other current assets. The overall increase is 48.96 crores. This is on account of certain investments that we are doing in for our BIW projects, for our upcoming T-Volt as well as the Hyundai projects. And we have given certain advances to the vendors, hence there is an increase in terms of other non-current assets. Coming to liabilities, change in liabilities are on account of increase in borrowings by 185.1 crores and increase in trade payables by 77 crores. The long-term liabilities from banks and NBFCs has increased by 41.37 crores. This is predominantly increase at subsidiaries, and that is also on account of the long-term debt that we have taken in our subsidiaries amounting to 62.057 crores. And this is offset by a decrease in standalone entities where we had a repayment of 20.7 crores for the quarter. So overall long-term liabilities with a combination of the telco increase, there is an increase. Otherwise, overall there is a decrease that we had. Short-term borrowings have increased in standalone as well as in our subsidiary balance sheet. The predominant increase in standalone is because of the higher revenue that we had and the growth plan that we have intended to carry out. And in terms of subsidiaries, because of the acquisition that we had carried out and because of the working capital which has got transferred, there is an increase in terms of the short-term loan. Increase in trade payables in standalone as well as consolidated. Overall, the equity has increased by 71.36 crores, and we are happy to inform that equity and reserve surplus has crossed off the 1,000 crore mark as of September 30th, 2025. In terms of free cash flows, we had a good continued free cash flow, the amount of 119.47 crores, and this is including the working capital changes that we had. And in the amount used in the net investing activities is 212.22 crores. That is on account of acquisition of telco, as we have alluded, and the capital advances that we have given. The amount from this has been used for financing activities, which is for short-term and long-term borrowings that I have explained earlier. With this, I conclude my presentation on the financials, balance sheet aspects, segments, as well as the cash flow. We are happy to hand over back to the room and for the investor community for their questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Shubhankar Gupta from Equity Capital. Please go ahead.
Hi, am I audible?
Yes, sir, you are audible.
Hi. So first question is I'm not sure, but I think Srikanth said that the growth for PEB has been around 5 to 10%. Am I right?
No, 30%.
30%. So, and PEB division is what, 50% of the business? That's correct. Around roughly.
Could you say it again?
He was asking.
No, I'm saying that PEB is roughly 50% of the business, right? Roughly 48 to 50% of the whole.
About 45% from a revenue standpoint, yes.
Okay, 45%. So, and overall the sales have grown by around 22%, right? So that would mean 45 into 30%, which is around 14, 15%. And remaining is the growth from other sectors, which means the other segments are not growing as well. Is my understanding lacking there?
I think your voice is a little muffled, but if I can paraphrase, what you said is you took the 45% revenue run rate and you
Correct.
multiplied the PAT growth with that, and then said that the PAT growth which came from PEB is about 12%. And I think that's an assumption you can make, but for us, we don't necessarily provide segmental revenue breakup in that sense down to PBT. So, but yes, it's not an unfair assessment, but obviously the actual numbers there may be moderate variations on what you said, but that's the general trend, yes.
Got it. Aditya, and also so there are peers, right? And now we've listed peers who are revealing numbers for multiple segments as well. So I'm not clear on why don't we reveal the same? Like, is there a specific reason as to why we don't do that?
Could you say that again, sir? I mean, your voice was muffled. Your question, you said they're listed players who are, our competitors.
Who are giving the segment, yeah. For example, let's say Intraj or EPAC Prefab, they have multiple segments as well. So they are revealing all segmental splits. So I'm not clear as to why we don't reveal the same.
That's a good point. So Interaj's primary revenue stream, to my knowledge, is PEB. They may have other moderate segments which contribute a much lower percentage. But if you look at Pennar, yes, the 45% of our revenue is that. And even those brands, like our PEB business itself is Pebs in India, Ascent, and Telco now. So the three revenue streams, three brands that we operate. Now, as it stands, all three brands are very well focused and we're on growth, and all of them have had capacity expansion come in. So the next few quarters, all three of them will do well. But if we were to go to the extent of providing the breakup from a segmental point of view, we would need to break our revenue and P&L into many more components than we traditionally have done. So while this is something we're exploring, we need to find a better way to do it rather than give you PEB, give you, let's say, boilers and give you process equipment and engineering separately. So we need to combine it into boxes which are not more than 2 or 3 boxes. We're working on how we could provide that, but I do get what you're saying that 45% merits separating it out. We will discuss this internally and get back to you, sir.
Sure, Aditya. All right. Thank you. Thanks for this.
Thank you. Thanks.
Thank you. The next question comes from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Yeah, I'm audible, sir.
Yes, please go ahead.
Yeah, okay. Thank you very much, sir, for this opportunity. So first, I just wanted to understand, last quarter, I think we had some subsidiary, some acquisition-related, cost-related, around 11 crores, right? Telco-related.
Yes.
So has that gone away in this quarter, or was there some impact this quarter as well?
There was substantial impact of that, the acquisition cost. It straddled 2 quarters. So the reason perhaps for some of our muted margins are these extraordinary costs that came in both in Q2 and also there's a little bit in Q1 as well. It is a substantial acquisition, and as Srikanth said, our total capital was about 200 crores. So now the rationale for making it is sound, and since the acquisition, our order backlogs have also expanded massively. So, but it's all over now. There's no tailwind or there's no other acquisition cost to be taken into account. It's all been completely accounted for in Q2.
How much was that? Can you quantify that?
we will try to get you an overall thing, but it included things such as the cost of the investment banking fees and other charges which are there, getting the employees in pre-operative. So a substantial amount of non-revenue generating costs that came in the P&L. We'll get you that number in a bit. Right now, I don't have it. We have it.
And last quarter, I think the similar cost was around 11 crores, right? That you mentioned in the last call, that legal cost and all, etc., was around close to 11 crores in the second quarter.
Overall, other costs for that, I wouldn't believe it is exactly to that extent, but we'll give you a breakup. We'll prepare that breakup and make sure it's shared with all of our investors.
Okay, understood. So from this third quarter onwards, you don't expect such costs to come, right? Would that be a fair assumption?
That's a fair assumption from third quarter onwards. So the story that we've always had is that we've always had these margin expansion for the last 4 years. And that is something we've stated as something that's a key metric for us to continue to perform on. So this quarter, not a massive amount, but we did have our PAT margins 3.59 to 3.56 or along those lines. So about a 3 basis point decline. Now we want to go in the other direction. So these extraordinary costs, a little bit of other issues as well that we were resolving during the quarter. I had spoken to our labor issues that we've had. All of that got resolved in this quarter. So we took a little bit of a hit there, but all of that goes away in Q3. In Q3, you shouldn't expect to see any of these acquisition costs or any other significant expenses, other expenses.
Okay. So this labor and along with this acquisition, I think your reported PAT margin were close to 3.6%, right?
That is correct.
So what was the basis point impact you mentioned? I missed that because of all this, the labor shortage or the acquisition cost impact.
Those were some of the reasons. I mean, it's a more diverse. I may be oversimplifying it to say that those two are the reasons. But overall, these one-time expenditures have brought the profit margin down a little bit. Whereas our stated intent and our commitment to you is that we continue to grow margins quarter on quarter consistently, which is what we have done over the last 4 years. So it's what we had in this quarter, but we are quite confident that come Q3 we get back to PAT growth, percentage growth. Not just value growth, but also percentage growth.
So any aspiration? I mean, will it be possible to quantify? I mean, any aspiration in terms of your margins, PAT margin? I mean, in by fourth quarter or by next year, where we want to see ourselves?
My team and I will commit to both the value of PAT and the margin growing in Q3. That is something we have packaged in now. The exact value would be a forecast, and we don't really provide those. So my apologies.
Okay, understood. And just one last thing from my side. In terms of growth, I mean, if you have to see growth over the next 2-3 years, what sort of CAGR we might be looking at?
So what I can speak to is not a forecast for this year, but we are very confident of double-digit growth in revenue and profitability, as always said. If we can make that tighter, because double-digit is all the way from 11 to 19 or 10 to 99, right? So in order to give a little bit more clarity, I think we're upgrading our internally. We're discussing with the board as well how we can make that a little bit cleaner. From my side, I think what we can commit to is that a floor of 20% is what you can expect. That's what we have discussed at the board that we would want to communicate to our investors. On a profit basis, we are quite confident that we'll be able to bring in sustainably over quarter on quarter for the next few years.
Okay, a 20% profitability growth, is that what we might be looking at minimum?
That is correct. PAT growth, yes.
Okay. That's very helpful.
And obviously the major vector to do that is revenue growth and margin expansion.
Absolutely. I got it. I mean, that's very helpful, sir. Wish you all the very best. Thank you.
Thank you.
Thank you. The next question comes from the line of Harsha from Seven Rivers Holding. Please go ahead.
Yeah. Hi, sir. Good morning. So just wanted to understand that the 35% growth in PEBS is after including the telco acquisition, right?
No, the telco acquisition, we had no revenue recorded in that quarter. We completed the acquisition, but Shrikant, perhaps you want to expand on
Yeah. Overall, the increase in the revenue that we had is on account of predominantly the India business, PEB India business, and PEB US business. PEB telco acquisition has been completed, and the addition is just last 2-3 days kind of a thing. Is that included? We will overall, if you see, it is not significantly the changing the numbers on account of telco acquisition, and the revenue we will start seeing from the next quarter.
So Q3 full quarter, we will, the flip side of it is Q3 full quarter, we will have telco. Yes.
Okay. So telco, you said the annual revenue run rate is to the tune of 45 crores.
Could you say that again, please?
Earlier you had alluded a certain amount of revenue that telco does. What was that figure? Somewhere around 44, 45 crore.
Annually? No, it will be way more than that.
For telco?
No, it will be much more than that annually.
Okay. And sir, on margin side, so gross margin side...
we would, conservatively, you can take over 100 crores per annum from telco, just from telco.
Okay, and what was the acquisition price, the consideration that we paid for this?
It was about $12 million, 14, my apologies, $14 million including at an enterprise value, yes.
Okay, understood. And sir, in this quarter, our gross margins were off by 2%. So any one-off or anything that you would like to clarify on that bit, and what should we take this number going forward?
So which margins did you say are off?
Gross margins, excluding the other income.
So gross margins are off by that amount. It was a mixture of factors. Primarily, I think, as I mentioned in the last conference call, the labor issue that we had solved, but we solved it late in the quarter, so some of that got packaged in. We did have to increase our labor costs. We typically depend on a fair amount of contract labor, and a variety of factors concluded to make sure that we did not have the labor supply we needed. We have now solved for it, but some of the quarter got caught up in it, and we are sure that these are not recurring costs. So an operating margin point of view, as with a PAT margin, we will be back to growth from Q3.
So when you speak about labor issues, so did we overpay the labor to get the work done, or did the revenue not come through in this quarter because there was labor shortage and these revenues will come in the later quarters?
You are correct in that there is an increase in some of our variable costing. The tune is maybe a little bit of detail would help. We have had to increase our labor cost by about 500 rupees per ton. Now, from a basis point operating margin point of view, that's about 0.4% of operating margin potentially getting reduced if it applies across the board. It's a little more nuanced than that. It doesn't apply across the board, but it is more than 50%. So the overall impact on our margins per se might seem substantial at 30-40 basis points. However, because we are able to bring this in, we're now also upgrading our revenue a fair amount, right? For all three of our PEB brands, which is PEBs in India, Ascent and Telco, all three are going to scale up quite strongly. So combating that perhaps substantial increase in operating cost is scale effects and a much larger revenue. So yes, on operating margin, which is gross margin contribution, but by the time we come back to EBITDA, it's a huge positive. So yes, the answer is yes, short answer yes. Longer answer, it won't matter. It's actually a huge positive for us because it's not an extremely large increase. And what's fighting it is better operating leverage and frankly the scale impacts, even if a gross margin didn't increase or change by much, just what falls down to EBITDA and PBDT is much more from a number point of view and because your fixed cost is getting rationalized on a larger revenue base. So overall, you will continue to see margin increases in both in all three of our revenue streams.
And sir, because of this, of these labor issues, did we lose out on any contract? Because I mean, PEBs by nature is a very time-sensitive project. So did we lose out on any project? Because a lot of our competitors did very good numbers in India, and I mean, anything on that front?
I think in US, no. I think our order backlogs are India also order backlogs are grown. Our India order book now stands at around 880 crores, and we expect it to hit 900 crores by December and cross 1,000 crores in the next few months. So not getting impacted from a customer point of view, we are able to go and get orders as we see as we need to, and filling up with additional capacity will make sure that there's no challenge over there. But yes. If we let's say our capacity utilization is at 70% and we need to get to 80%, and these are not exact numbers, I'm just giving you more of an illustration. That reduction does result in lower revenue, which we did see in Q2 and Q3. We would have had, our growth would have been even higher, but for those concerns. And that obviously results in some amount of delay perhaps. So we are quite sure that it won't impact on the medium term, but short term, yes, there's been some impact in terms of our ability to grow and scale, what we alluded to. It just took us a little bit longer because of the unique nature and by which we have our labor. Most of it is contract, so that affected us a little bit. We have since found strong solutions to that. We also invested a lot in automation as well, as the other side of this. So the major bottlenecks, which include end plate fitment and surface treatment, short blasting and painting, all of those, there's been a heavy amount of automation that has been brought in, along with other capacity increases as well. So I'm confident that this issue is behind us, and with the strong order book, marry that with this, and Q3, Q4 should be very good quarters for us from a pre-engineered building point of view, and frankly from other business as well.
So just stepping a couple of quarters back, when we had mentioned that the focus will be on the core business while the legacy business will keep on coming off. So, I mean, and the legacy business is typically a single-digit EBITDA margin, while our core business has much higher margins. So as we go forward, do we still think that we can end Q4 at substantially higher margins? I mean, somewhere around 12.5%, excluding the other income, of course.
Mr. Harsh Shah, sorry to interrupt. You have to return to the question queue for follow-up questions.
Yeah, the question has already been asked.
Waiting for that.
The question has already been asked. If you can just allow them to answer this one. The question has already been asked.
To the moderator, ma'am, I understand. Please do, let's set a limit of 2 questions per caller. But since this question's been asked, let's go ahead and answer it because I think it's important. So, and pose that. Harshi, thank you for your question. With regards to margin expansion, as I had mentioned, it's a simple equation. As our scale increases and the scale comes in higher in the prioritized business units, I'm speaking not just of our pre-engineered buildings, but also our body and white business, our engineering services vertical, all of which are high margins. Margin expansion is something that will happen. And again, as I mentioned previously, this is a trend that's been visible from the last 3 or 4 years, where we've doubled our PAT margins in the last 2.5 years. So continued increase on that will definitely is something as a team that we sign off on, and we will tell you that will happen. As to the older businesses, just like we've done with solar, where we created a joint venture, we want to find ways where we realize value out of these, shall we say, our legacy business units. They're still strong in revenue, they're still profitable. I think they have to find good ways in order for the company to realize value. We have what we've done with solar can be done with other business units. From time to time, we will be able to give you clarity on how we intend to achieve that, and we are working on it, and we are quite confident that over the next quarter or 2 we give you a lot of clarity on this. So they will fall away from our revenue, yes, but overall revenue and profitability for Pennar, we are extremely confident that we'll continue to grow and scale, and the margin picture will continue to improve. Our modeling is quite strong on that.
Sure, thanks a lot, sir.
Thank you. A reminder to all the participants, please restrict yourselves to 2 questions. The next question comes from the line of Rahul Kumar from Vekaria Funds. Please go ahead.
Yeah, hi. So just on US PV segment, Srikanth, if you can answer, the gross margins and the EBITDA margins have declined. Right? So what drove that, and what would be the outlook over there?
I think what we have alluded to it earlier and explained it in detail. The margins have fallen predominantly on account of labor increase cost that we had. This increase has impacted our margins, and now that this problem is solved, we will have expansion in margins in the coming quarters. Does that address your question?
Actually, I was asking for the US PV segment.
I think a US PV segment operates at a gross margin of about 30%, but it can fall as low as 28 and go up as low as 32. Rather than a commodity price issue, that's more because of the nature of the jobs that we are executing. If the secondary to primary ratio, it moves around a little bit. So think of it as a range bound 28 to 34. But I do want to say that while that looks on paper like a massive swing. When you get to the EBITDA and the PAT margins, that's remarkably stable. So that is something that we are quite confident of being able to retain. I would say, and Shrikant, I request you to elaborate on this, but we're not seeing any decline in margins. If anything, I think we will do better from a PAT margin and a PBT margin point of view in our US business, specifically for Ascent and Telco.
Okay. Okay, thanks for that. No, I was asking, I think for this particular quarter, I think what I see is there is some compression in the margins. I just wanted to understand what actually drove this.
So, I think from an overall operating margin point of view, the gross margin, as I mentioned, instead of our usual 30-32, we would have seen 29 approximately. Not something we're very concerned about. I would strongly guide you to look at our Ascent and our TGI margins look at it on an EBIT or a PBT basis, or maybe even a PBDT basis. That is what we monitor, and we tend to fill up our order backlog accounting for that. So, in that perspective, the 200 basis point move that you alluded to, these are natural swings that happen based on the nature of the jobs that we're undertaking. But what we're quite confident of is that at the EBITDA level and at the PBT level, you will not see that happen. I don't understand what you're saying. 200 basis points seems like a massive swing, but not really something that we take into account. We don't try to fix our gross margin at a certain level because the nature of the jobs changes.
Okay. And for US only, I think what I see is the order book actually has declined quarter on quarter from 54 to 51. So, I mean, why was that? I mean, how is the order flow environment now?
Every half year we tend to do a little bit of pruning on our order backlog. So you do see a decline, but overall our active order backlog has actually gone up. In fact, the month of October was one of our best order booking months ever. So again, not something we're concerned about. We have no concerns from an order backlog point of view in the US. It's quite strong, and there's a lower down order booking order called active order backlog, which is all the clearances are in place, and our customers are effectively saying, please ship as soon as you can. Engineering's done, shop drawings are done. So that puts us in a very good place to quickly turn that around. Not an issue. The 54 to 51 is just it's something that the quarter end picture. Right now it's actually well above 54, and we expect that trend to continue. Overall, we expect to book about 10 million a month going forward as well. So that's something that we have, and that's reasonably well baked in. There's new DMs that have been added, and the addition of Telco, in fact, boosts that up a little more as well. So, no concerns there. I don't think we have an issue on order backlog, and the active order backlog is healthy, and our ability to push revenue out is quite strong.
Okay. So you do expect traction in the revenues as well for the US PVB segment for next 2 quarters?
Yes, 100%.
Even though it's seasonally sort of a weak quarter, but still.
We were accounted for that, so it affects different revenue streams differently. Yes, December tends to be a muted month, but what tends to happen is in anticipation of that, a lot of people, we tend to have a very strong October, very strong November. That's one reason why order booking also in October has been very, very strong. But we do not believe that our PEB business in the US would be impacted because of the end of the year seasonality cycle.
Okay. Yeah, thank you.
Thanks.
Thank you. The next question comes from the line of Aniket from ABN Capital. Please go ahead.
Hello. Am I audible?
Yes.
Go ahead.
Yes, sir, you are audible.
Yes, thank you for the opportunity and congratulations on continued good execution down the path that you had guided us to. I had a couple of questions. Sir, can you tell us a little bit about the capacity utilization or ramp up for the new PEB facility currently, and just seeing what's happening in the industry, do you anticipate need for capacity expansion in the near to medium term?
So for the last quarter, again, our overall capacity utilization from a PEB point of view would have been low, on the lower side. Think of a number closer to around, say, 60-65%, and that's assuming an OEE of about 80%. We have since addressed a lot of that. We've had good production in the month of September, good production in the month of October. So I think for the quarter in question, I would from an overall basis, we'll be north of 70-75%. Typically, once we reach a 75% number, we tend to expand capacity, and we are doing some amount of top-up, not really relevant from a capex point of view, but we are expanding the number of skits, expanding the number of other fixtures that we have. This ties in well to our labor picture as well. We have tried to expand our labor beyond also what we have traditionally had as well from a per ton basis. All of this is going to result in higher execution, higher capacity utilization. We definitely project that for the quarter in question will be north of 75%.
Okay, sir, fair enough. And just a couple of bookkeeping questions. I think you mentioned earlier already. Can you just repeat what the telco revenue on an annualized basis approximately will be? And also there's a large 8-odd crore around comprehensive income FX translation entry. So if you can just explain what that is as well.
Okay. For next. Yeah, the telco acquisition, relatively, as we have explained earlier, it will be close to 100 crores in terms of the annual. The foreign exchange fluctuations because of the volatility that we have in the foreign exchange revenue, whatever the earnings, whatever the collections that we have got, and because we are in factor, there is an exchange fluctuation which has changed the number. It's roughly 2.8 crores, 2.99 crores is on account of exchange fluctuations in the current quarter.
Okay, thank you so much.
Thank you. The next question comes from the line of Vidisha from CRK. Please go ahead.
Hello, sir. I want to ask that earlier you had guided 7.5% at PBT margin level. So can I know a tentative timeline by when can we achieve this? And also, what will be the growth levers for the same?
So you would see a quarterly trend of our PBT and our PAT margins both increasing. This quarter is an aberration because of the reasons that we had mentioned, but we expect it to be an extremely short-term impact. Q3 onwards, we've analyzed it. We looked at what we're looking at from a revenue and profit standpoint, and we're quite confident that we get back to growth. Over the longer term, as these margins get expanded, I think 7.5% is what we've guided to as call it a terminal velocity of our PAT margin, of our PBT margin. I'm sorry, and the time frame would be in the next 3 years.
Okay, and what will be the growth levers contributing to the same?
Could you say that again, ma'am? Growth levers. Growth levers. Okay. Yeah. So we have 5 growth levers. Our body in white business, engineering services, boilers, process equipment, pre-engineered buildings, and also our US business, Ascent and others. All of these have large addressable markets. All of them we have rightly or wrongly low market share, and consistently growing our market share in these large addressable markets makes revenue growth and profit growth automatic. It's the same mechanism we've been using for the last 3-4 years, and as our revenue shows, we're not seeing an issue growing using this model.
All right. Thank you, sir. That's it from my end.
Thank you. The next question comes from the line of Ashish Soni from Family Office. Please go ahead.
Sir, we keep running into issues for Raebareli plant. And so is our planning right? Because typically what I have seen in UP, the labor cost is not so challenged. What's the issue? I'm not able to pinpoint because some of this Raebareli plant, last 2-3 quarters, we have been struggling with something or other. So just can you throw some light of management thought process when you set up a plant like this?
So the labor issue, because let's speak specifically to that, because of the majority of our PEB manpower in India being contract labor, it cut across plants. It wasn't essentially just a rivalry issue, it cut across plants. The reason for that is the kind of manpower we need, especially it's reasonably automated until what we call the beamline ends, right? So you get these plates, you convert them into frames and webs, and you weld that together. And then at the end of it, there's end plate welding and further touch-up, and then short blasting, primer, then epoxy, then 3 coats of paints. That entire chunk from the end plate to that is an extremely manual intensive process. And it's also skilled and semi-skilled. The process of attaching an end plate is actually quite critical from a quality control point of view as well. So it's also an extremely difficult thing to automate, though we've been working to do that. Now, in the geographies we've been present in, getting contract labor from welders, fitters, assemblymen in the volumes that we needed was difficult. To give you a taste of the numbers, our total shortfall was well in excess of 300 people, skilled manpower. So that is what contributed to this. We have now solved that problem. So that's the only other reason. From otherwise, from a capacity point of view, from a load point of view, supply chain, raw material, border items, none of those are issues. It was typically just this execution on this, the weather to some extent, but that's a problem for everyone. So it's not, and it's also not something we can address. So there's no point talking about it. But fixing labor, fixing that, is effectively going to put us in a place where we can see higher capacity utilization. And that's something we're going to reach in Q3.
Okay. And you spoke about an aspiration to reach $1 billion revenue a year back, if I recollect. So where do we stand on that? And do you think achieving that in like 3, 4, 5 years? What's your vision, at least for the company?
We're not curtailed by $1 billion as a thing. I mean, it's obviously a target that we have in mind. It's an intermediate target. I think from what our plans and what that we put in place, as I mentioned, our addressable markets in each of these are so high, and the largest companies in these fields are so high, that as we grow and scale, we're not curtailed by $1 billion. But if you're asking us what our ambition is, I think, as I mentioned, a foundational 20% PAT growth is what we would want to look at. I mean, that's a non-negotiable for us. If you marry that with large addressable markets, then an output sort of revenue number. So we'll continue to grow double-digit revenue-wise as well, and that would mean we will reach those numbers that we have projected in the next few years.
Okay, thanks a lot.
Thanks.
Thank you. The next question comes from the line of Lovis from Burman Capital. Please go ahead.
Hi, thank you for the opportunity. So I had one question related to the PEB vertical. So all other players in the industry have reported very strong growth, even though 2Q is generally a slow quarter, and you have also reported very strong growth despite having some labor issues. So my question really is that, is there any one-off during the 2Q that helped everyone in the industry, or is this growth momentum sustainable both for the company and for the industry as a whole?
We're very confident of strong growth in all of our PEB verticals, which are PEPs, Ascent, and Telco. That's across geographies. We have not just on the base of our order backlog as well, in terms of improved capacity utilization also that we're going to bring in. I think if you marry a big order backlog with good capacity utilization, you will have revenue growth, and that's what we're seeing right now. So yes, we could have done a lot better, but as I had mentioned last time as well, it took us a little bit of time to fix that issue. Now it's now fixed, so we are quite confident that growth will not be an issue.
Thank you. The next question comes from the line of Dilip Kumar Sahu, an individual investor. Please go ahead.
Yeah, hi Aditya. Can you hear me? Hello.
Yeah,
yes, sir, you are audible.
Yeah, Aditya, this the diversified engineering sales growth versus profit growth and PEB sales growth versus profit, there's a big divergence, right? One, diversified engineering is growing at 10-12%, but profit has grown by 18-20%, whereas PEB has grown at 30%, but profit has grown at some 10-12%. Can you tell me two things? One, which particular line of business in diversified engineering is leading the profit growth, or is it pure product rationalization that you have been doing? And in PEB, had we not had these acquisition and liability issues, could we have just extrapolated the revenue growth with profit growth?
So the first question which you had, which is which revenue stream is giving us better margins, I think structural engineering stands out. I think they've done exceptionally well, and they'll continue to do exceptionally well. We are, quite frankly, even there, we're capacity constrained from an engineer's perspective. We're hiring engineers as quickly as we can to grow and scale that business. But that's continuing to do well. Boilers, the order backlog also has grown very, very strongly. So all of our key verticals are growing and scaling, but as you said, the profit to revenue mix is looking a little different. PEB, as I said, as I requested last time, when we last spoke, we were in the middle of solving the problem, but we had then addressed it. There's a little bit of a tail that fed into Q2, but now with what we have on the table, with telco coming in, we are very confident of strong growth in this vertical. So that's the picture from a PEB growth vector point of view. So I think diversified engineering is quite strong. I think.
No, my question on PEB is that if we had not had these two issues, which is basically acquisition and liability, would we have grown at 30? Our profit would have grown at 31%. That was my question.
Short answer, yes, we would have had stronger growth if we did not have these issues. Since, from the base of what I've already told you, if our capacity utilization was higher by 10%, for example, then the revenue for the quarter would have been higher by 100 crores. So obviously that filters down to bottom line.
Sure. Okay. My second question is regarding this telco acquisition. How is the new structure? How is US business looking to us now? Are you going to have one organization, one sales team, selling two lines of businesses, or are there going to be two separate teams? That is one. And can you just tell us about how is the market trend in US? Because we hear a lot of investment upcycle in US, particularly in power, oil and gas, and data centers, etc. And since we have taken a structural engineering, structural steel business like telco, which is primarily into infrastructure kind of stuff, how does it look different as compared to how it was maybe 3 years back when we had only Accent?
So from a revenue stream point of view, everything falls into PGI. We do monitor them as separate revenue streams, but what you would see is a consolidated picture, includes all of our US revenue coming out. That would be in PGI. That's question number one. Market trends, order backlogs are continue to be strong. I think the larger US macroeconomic picture, I'm not certain of. Honestly, it's not something that we monitor. What I would guide you to is monitoring what's called as the non-residential construction index. It's an excellent predictor of how the metal buildings business, as the pre-engineered building business is known, of how that entire overall market is growing. But I do want to guide you to one other thing. Just as in our other revenue streams, the addressable market for structural steel and metal buildings in the US is close to about $80 or $85 billion. So obviously our market share there is low. So we can afford to, even if those markets are growing, but for us the challenge is to quickly build up scale and capacity, and telco is an attempt to do this so that we can massively expand our execution. All of that work has been done in the last few quarters, including the cost that we had to take. So the picture that I am trying to tell you is we're a little bit diverse from what's happening macroeconomically in the US. Though that's positive, the larger positive is nothing less than us building up capacity and building up those capabilities in terms of team, in terms of sales, business development. That's what we have done. That's why we are so confident that PEB overall will do really well in the next few quarters, because it's just a combination of low market share, high growing order backlog, and our capacities have now come online, and our acquisition has now come online. So that's just a consequence of that. So, but yes, oil and gas, data centers are major markets for us.
Great. So you are saying the sales and manufacturing assets are fungible, so you can leverage each other, and hence there will be a synergy in both in this acquisition.
I'm sorry, I'm not sure I understood. You said sales and marketing.
I'm saying that the current Accent sales and manufacturing assets and the telco sales and manufacturing assets, are they fungible, or are they going to be like separate?
No, they are separate. They are separate markets.
Okay, thank you. Thanks a lot.
Thank you.
Thank you. The next question comes from the line of Vaibhav Jain from Omkara Capital. Please go ahead.
Hi, sir. My name is Vaibhav. I'm sorry if this question's been asked. Are we doing something to bring down the debt immediately, and are we considering a QIP or a rights issue?
There's several corporate actions that are debated at the board level. Once we have something cleared by the board, we will communicate that with you. My apologies, but I would not be able to share anything on corporate actions as of right now.
But are we looking to do something about the debt?
100%.
Thank you.
Our debt equity is right now 0.8, and we intend to bring that down.
I understand, sir, but it's a drag on profitability every year if we have 150 crores going out.
That is correct. That's correct. Now, I do want to guide you to something. The vast majority of those interests is LCs and other non-cash instruments and interest costs. So that's not going to look at it more as a percentage of revenue. What we always guide it to is a certain percentage of revenue our model calls for, which allows us to grow and scale. We want to grow revenue. We want to grow profitability as well. On a sustained basis, what gives us confidence is having a large order book, having large revenue, and interest cost is a certain percentage of revenue. That number around the 3% is what we're comfortable with. So a little north of that, 3.xx right now, but we will, as I described you, we will reduce that. I think there's a certain debt equity level that we can achieve and sustain. So think of a number 0.7, and that's fine. More than that, it doesn't really matter. I think our goal should be rather margin expansion on our EBIT and margin and also revenue growth. So we shouldn't. There's a certain amount of debt that's healthy. As of right now, perhaps it's a little higher than what we are comfortable with. But I do again want to guide you, backed up by a lot of current assets, and a lot of it is non-cash debt. Our long-term debt is actually quite small. It's about 120, 130 crores, which is probably a quarter of our EBITDA.
Thank you. The next question comes from the line of Ankur Kumar from Alpha Capital. Please go ahead.
Hello, sir. Thank you for taking my question. Sir, I wanted to understand in the press release, we have talked that we have won 956 crore orders, which will be executed in the next 6 months, next 2 quarters. But in the PPT, PB order book, it hasn't grown much when we compare. So can you comment what difference between these two things?
The differences are between the September 30th number and what we're at right now, sir. So the consolidated order backlog also in the last 1 month, 2 months has grown a lot for us. So that's the reason for the differential in that. But yeah, I mean, our order books in PEB, and Ascent and others are all right now at a record high. They've never been this high. So we have no order book problem.
Can you comment how much is it higher versus say last year same time?
It is higher by more than 20% across businesses. Our overall. So let me put it this way: every quarter we used to report about 600-700 crores in our order book growth, and now we are reporting 956. So that number is there. But I'm not saying we're 50% across the board, but that's a quarter picture that you're seeing. But it's strong growth in order backlog. Quite frankly, it could be even higher. We need to quickly increase our execution and our revenue, and then we can expand it further.
Just to clarify, the order book that we have disclosed in the investor presentation, that is only PEB order book. And the US order book is again disclosed separately. So basically we have to, in order to get the overall order book, we need to add all the components of business, various business divisions. So apart from PEB India, PEB US, boilers, railways, hydraulics and steel. All those orders put together is 956 crores, which is a combination of all the revenue streams that we have. And the order book that is included in the press release is only on the PEB part of it, which is India and the US, both given separately.
Got it. So when we say we will execute this 956 crore in the next quarter, this will be the extra, and what else will be the normal book which we will continue to execute? Can you comment roughly on that?
sorry, your question was about larger order book resulting in larger revenue?
Oh, yeah. I think what he's asking is basically what will be the execution period of this 956 crores.
Oh, next 6 months.
4 to 6 months is generally the execution timelines for this order book.
No, that is given in the press release. I'm asking, apart from this 956, is there some normal order which will continue to execute in the next quarter? What will be that amount roughly?
Oh, I understand. Yeah, so the way our order book based businesses is roughly only about 60% of our revenue. There's a lot of other what we call scheduled revenue. Body in white gets covered in this, structural engineering gets covered in this, BIM gets covered in this. So we don't report an order book for that because it's not orders, but what we call regular month-on-month revenue that keeps coming in. And we don't quote orders, it's more perhaps it's a pricing discussion, but overall it's steady revenue that just comes in. We don't need to go out and book orders for that.
So that would be 40% of the business.
That's correct.
Got it, sir. And sir, on margin side, given such strong order book, can we expect to margins to improve? How much do you expect to improve?
As I carried to the previous questions, this quarter, the 2-3 basis point is an outlier, primarily due to some exceptional costs we had in acquisitions, a tail of a labor issue that we had, but we will make sure that Q3 would be better. We're quite confident that happens.
Sure, sir. Thank you and all the best.
Thank you. The next question comes from the line of Aryan from Pennar Industries Limited. Please go ahead.
He may not be Pennar, I think is wrong.
Okay, sir, go ahead, please.
Mr. Aryan, please unmute yourself and proceed with your question. There is no response from the side of Aryan. We are moving on to the next caller. The next question comes from the line of Shubhankar Gupta from Equity Capital. Please go ahead.
Hi, Aditya. So I think a follow-up question from what Weber was asking on the debt bit. Long-term borrowings in March 25 were at 206 crores, right? Right now it's at around 247, around 250 odd crores. Similarly, for short-term borrowing, it was at 570 crores in March 25. Right now it's around 715 crores, right? So just want to understand where exactly are we using this debt, and at what, let's say, that interest rates have we raised this sort of loans?
Yeah. Just to clarify, the total increase in the borrowings are on two counts. One is, as you said, long-term and short-term. The long-term borrowings predominantly, the increase is on account of the acquisition that we had for the telco. That's predominantly the reason for the increase in the long-term borrowings. In fact, in India, whatever the repayments that we have done, there is a decrease of close to around 20 crores that I have alluded in my opening remarks. So there is an increase in subsidies close to 62 crores, and there is a decrease in standalone by 21 crores. Overall, in terms of the debt picture that we are trying to bring it to you. In terms of short-term borrowings, there is on account of two. One is India and one is the subsidiaries. The increase in India is predominantly for the increase in the revenue that we had during the current year and on the back of increased order book. Similarly, in the US, what the increase is on account of the working capital utilization of the new telco entity that we have. So part of the problem is close to around 78.37 crores is coming from this one, and balance 58.16 crores is coming from the US. So that's the overall picture in terms of the India and US businesses put together debt. Earlier, we never used to have debt in our subsidiaries. Now that they have reasonably grown and we are able to have the demonstration, we have some debts, and that's how the numbers are. I'm trying to explain the standalone as well as the consolidated debt picture to you. Hope that answered your question.
Okay. Yeah, that answers one part of it. At what, let's say, what is the blended rate at which we have taken these, like weighted average of the whole firm right now?
Yeah, India rates are completely different from the US rates, and India include, and India, large portion of our debt does not even include the non-fund utilization of the LC and limits that we take. So if you take finance cost divided by the borrowings, you would not get the rate, because large portion of the non-fund based utilization also gets predicted and injected in terms of finance cost. But to answer your questions, in India, we are at around 10% in terms of our the finance cost. And in US, around 5 kind of 7, I believe, one should include index. 7% is what I... 7% is, 7% will be in US.
Got it. Okay, that's helpful.
Thank you. The next question comes from the line of Raj Saraf from FinInvestor. Please go ahead.
Sir, just a couple of questions from my side. I read your last conference call transcript. So what I can perceive by reading this, that you were quite confident about this labor issue a solution, and then we came across this result. So what is the risk going forward that the guidance which is now upgraded given by you will not be met? And if you can just give a ballpark number, it will be helpful, because we are seeing margins of your peers, especially in PEB. They are now quite comfortably going double digit and even further. So these are the two questions.
So I'm familiar with our competitors and how they're performing. I think the healthiest thing we can do is look into where our operating margins are different, because that's what's comparable on a company-to-company basis, and then execute, right? Execution. The more revenue you have at a market rate of operating margin, then that's outputs out your EBITDA, which outputs out your PBT. So we're going to continue doing it. I think the primary difference that I see between us and our competitors is perhaps a 300 basis point margin. We are looking at how we can resolve that. It can either be a supply chain issue or an engineering issue. We're looking to see ways we can resolve that. It could also be a scale issue, because some of our competitors are perhaps substantially, not tremendously, but about 30-40% larger. I think our growth rate being high makes sure that we can continue to gain market share. If not with respect to one competitor, then at least in terms of the overall market. So what I and the CEO of our metal building businesses, our PEB businesses, what we're looking at is consistent, sustainable revenue growth, making sure margin expansion happens and profit and cash flow generation follows through. So that I'm quite happy with what they've achieved, and I'm quite confident that we get to a point where we improve on those numbers. Q3, Q4 itself should illustrate a lot of improvement on those numbers. So that's how I see it. We are monitoring what our competitors are doing, but for obvious reasons, it's not immediately transplantable to a strategy. I cannot go and say, okay, they're doing so much better, so why don't we do also equally better? Our overall picture is what matters, and we are larger from a revenue standpoint and a profit standpoint than any other listed entity in this space. And of course, with a consolidated revenue standpoint is what I'm talking about. We look to leverage those strengths, and I think for us, as far as we are concerned, it translates completely into a large order book and execution issues. So I'm quite happy with our goal and right now. You spoke of guidance. We did not miss our guidance. I think what we've always forecasted is revenue profit growth, and we've had that. Could it have been better? Yes. But as you alluded to the labor issues and other issues, we are now quite confident to solve for that, and there's other revenue streams which are strongly growing in Pennar as well, and also contribute a lot of profitability. So the blended picture is one of robust revenue, sustainability, and profit growth as well. So, and we are watching what our competitors are doing. We will make sure that from an operating margin point of view, we get to where they are. There's ways and mechanisms to do that, and once we complete our execution, first you solve for revenue, then you go down to the cost items. Once you solve for that, we will get there in the short term.
And just for a clarification, sir, so you just upped the guidance in PEB segment up to 30%, sir. Am I right, sir?
Did you say revenue growth in the PEB segment is 30%? That is accurate, yes.
Yeah. And so this is for annualized basis or leftover the year, sir?
I'm sorry, could you repeat that?
30% growth in PEB segment is annualized over FY25 or for the rest of this year, that is S2?
No, 30% was on the quarter. Q2. What we're guiding to is good growth in Q3 and Q4. We are not giving you a specific number as a percentage growth, but yes, it will be a good number, substantial number.
So right now, sir, we are inching with 20% growth in PEB segment. So it will be better than that in Q3 and Q4?
With the addition of telco, with PGI doing well, I think they're seeing a very good Q1. They use US, so US Q1 is what they would look at, which is Q4 for us. I think you can look at the rest of this year being very strong for PEB.
Fine, sir. Thank you. Thank you very much, and best of luck for future.
Thanks.
Yeah.
Thank you.
Before we just end the call, we are continue to engage with the investor community on a quarterly basis. Please do reach out to our investor relations and the Ad Factor agency in case you want to get in touch with us. And in case there are any questions which are unanswered and other things, we'll be happy to answer those questions in the every quarterly meetings that we do with the investors. Thanks.
Thank you. Ladies and gentlemen, we will take that as the last question for today. I would now like to hand the conference over to management for closing comments.
Thank you for your calls and for your support, sir. We will look to execute on our plan, and in the medium term and short term, from the management side, I will commit revenue growth and profit growth and moderation of our debt equity to a low number. But thank you again for your support and while we execute. Thanks.
On behalf of Phillip Capital's India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.